Everyone's terrified of the US tech bubble. Valuations are insane and the AI hype feels fragile. But while you were doom scrolling, something else happened. The market nobody wanted quietly staged one of the most explosive rallies of the year. We're talking about Chinese tech. And this isn't just a dead cat bounce. This is a 41% surge that has crushed the Nasdaq's performance. The question is it a generational buying opportunity or the most sophisticated trap in modern finance? Let's get this straight. For years, investing in China was financial suicide. Beijing's regulatory crackdown vaporized trillions. Jack Ma disappeared. It was labeled uninvestable. But in 2025, the script flipped. Suddenly, Beijing is rolling out the red carpet for its tech giants. They're pushing an AI plus strategy to wire artificial intelligence into every corner of the economy. And a homegrown AI model called DeepSeek is rivaling ChatGPT at a fraction of the cost. Today we're breaking this down into three parts. First, the bull case, the insane numbers that have Wall Street drooling. Second, the bear case, the geopolitical time bomb this is all built on. And third, the final verdict, how to decide if you're a genius for buying or a sucker walking into a slaughter. Part 1, the bull case, or why this might be the easiest money you'll ever make. First, the valuations are just absurdly cheap. Buying US tech is like paying full price on Rodeo Drive. Buying Chinese tech is like finding the same gear at a pawn shop. Seriously, Alibaba trades at a PE ratio of around 20. Tencent is around 27. Compare that to their US counterparts, which are often trading at much higher multiples. And the kicker? They're sitting on a combined cash pile of over $3 trillion. They have more cash than many countries. Second, Beijing has gone from tyrant to cheerleader. In February, President Xi held a high-profile meeting with tech CEOs, promising support and market access. The years-long regulatory winter is over. The message to global investors was clear. China is open for business again. And third, the AI angle is real. They're not just copying the West. China is pushing for technological sovereignty, developing its own advanced chips, and funding quantum computing research with over 10 billion yuan. They're building a parallel tech universe immune to US sanctions. Okay, it's cheap, the government is on board, and they have a credible AI story. Sounds like a guaranteed win, right? Time to back up the truck? Not so fast. This is where it gets dangerous. Part 2, the bear case, or why this is a trap. First and foremost, geopolitics. The US-China tech rivalry isn't a friendly competition, it's a new Cold War. We're talking export controls, sanctions, and the constant threat of delisting Chinese companies from US exchanges. Investing in China isn't just a bet on a company's earnings, it's a bet that two global superpowers won't escalate their conflict. That's a hell of a risk to add to your portfolio. Remember, the government that giveth can also taketh away, on a whim. Second, you don't actually own what you think you own. For most foreign investors, buying a share of Alibaba isn't buying a piece of Alibaba. You're buying a share of a shell company in the Cayman Islands, known as a variable interest entity, or VIE, that has a contractual relationship with the real company in China. If Beijing ever decides those contracts are invalid, your shares could become completely worthless overnight. It's a layer of risk that simply doesn't exist with US stocks. It's the fine print that could cost you everything. Finally, China's broader economy is still facing serious headwinds. A struggling real estate sector, deflationary pressure, and slowing growth are all lurking in the background. The tech rally is happening in a vacuum of optimism, but the rest of the economy could drag it right back down. So let's recap. On one hand, you have a historic rally, dirt-cheap valuations, and a government-backed push into the future of AI. On the other, you have a geopolitical powder keg, sketchy corporate structures, and a shaky economy. This brings us to part 3, the verdict. So, is it a trap or an opportunity? The brutal, honest answer is, it's both. And which one it is for you depends entirely on your tolerance for a very specific type of risk. Political risk. The bulls are betting that China's economic self-interest will win. They believe Beijing needs foreign capital and a thriving tech sector to achieve its ambitions, so they won't sabotage it. They see the geopolitical noise as just that, noise. And they are buying up undervalued assets while everyone else is scared. The bears believe that in a conflict between ideology and markets, the Chinese Communist Party will always choose ideology. They see the VIE structure as a fatal flaw and believe the geopolitical risks are fundamentally unpriceable. For them, no potential reward is worth the risk of a total wipeout. Ultimately, this isn't a trade for the faint of heart. It's the definition of a high-risk, high-reward contrarian play. It's a bet that a totalitarian regime will play nice with global capitalism. For some, that's an asymmetric bet worth taking. For others, it's like playing poker with a dealer who owns the casino and can change the rules at any time. And if you want to stay ahead of the next market-breaking story, subscribe before the next bubble bursts. The market isn't a casino. It's a rigged game. The question is, are you playing to win or just to lose?